Welcome to our Capital Market Outlook to September 2025. In view of the sluggish recovery in Europe and the weak economy in China, the US will once again have to provide the world with momentum. Central to its ability to do so in 2025 is the yield on 10-year Treasury bonds. Where will they be in a year? And what is their current level telling us? Has the US economy remained strong so far despite the high interest rates? Or are leading indicators pointing to a weakening due to the high interest rates? Are the recent declines in yields the result of rising economic skepticism or falling inflation expectations? Can the US Fed lower interest rates, or does it have to? What we are pointing at here is that the US economy at present remains surprisingly difficult to grasp. Both positive and negative future scenarios are possible. We put the risk of a US recession at 38% in the next 12 months. But if a recession comes, we expect it to be shallow as the growth prospects for developed countries look in general. And a shallow economy does not have to be bad for equities. And it certainly is not bad for bonds, especially corporate bonds. Even more so as we are entering a rate-cutting cycle. We therefore see the future with a fair amount of optimism. But market valuations are making many investors nervous. Well-diversified positioning is the best defense against disappointment. Can central banks lower interest rates, or do they have to? Inflation figures are moving in the right direction, even if the last few yards are taking a little longer than expected. In particular, we will continue to keep an eye on wage developments in the service sector. For both the Eurozone and the US, we still expect inflation rates of just over 2% at the end of 2025. But as we expect growth to be sluggish, we don't expect this level of inflation to deter the central banks from lowering interest rates. By September 25, we expect the key central bank interest rates to be 4% in the US and 2.5% in the Eurozone. Lower interest rates should help US growth to re-accelerate over the course of next year. We expect 1.7% for 25 as a whole, down from 2.4% in 24. For the Eurozone, we expect a slight acceleration to 1%. Once more, the picture is looking encouraging in India, with growth of over 7% likely, while China is struggling to achieve the 5% target it set itself this year, and we see about 4.4% growth in 25. A final word on the US elections. We continue to believe that the Democrats will retain the White House, but we think they will still not gain a majority in both chambers of Congress, which will limit their legislative scope. Will it be a good year for equities or bonds? Despite an undynamic economic picture, a wide range of good investment options are open to us. Equities allow investors to participate in the growth of individual sectors and also, to some extent, to protect themselves from inflation. In bonds, investors can benefit from the quite high yields currently available and guard against economic disappointments. In equities, we believe the trend is your friend for now. We therefore expect the rally, which will soon be a year old, to continue as long as there are no big disappointments in interest rate policy or corporate profits. We expect profit growth of around 5% in Europe and over 10% in the US and emerging markets. Europe's valuations are much more appealing than those in the US. We prefer Europe, especially small and mid-caps. At the sector level, we see the right mix of growth, valuations, and defensive qualities in healthcare. Although we still have a lot of confidence in AI in the long term, in the short term, the nervous wait for profitable business models continues. Bonds are favored by falling inflation, a tepid economy, and the interest rate cutting cycle. We expect a further normalization of the yield curve, i.e., higher yields at the long and compared to the short end. This makes medium-dated government bonds maturities look attractive, particularly from a risk-return perspective. We also like corporate bonds in Asia, the US, and Europe, especially the investment-grade segment. Alternative investments may offer good diversification and solid returns. We remain positive on gold, which should benefit from falling interest rates. In real estate, we see stable to rising prices. Logistics and residential real estate are benefiting from strong structural demand drivers in almost all regions. In addition, we see upside potential in private credit, a source of financing that is becoming increasingly popular with companies.